Well, our markets are down just slightly right now, but of course this is after breaking through major barriers and right after that British exit vote. Since before the vote, we've been telling you a vote to leave the EU would not be the end of the world. In fact, far from it. And while other networks were bracing viewers for devastation and fallout and catastrophe, we're now seeing that, well, the fallout is all-time highs. Investors are making a whole lot of money, those that didn't panic. That was then, so where do the markets go from here? Jonas Max Ferris is with us. All right, Jonas, we've had a pretty good move here, and after the British hysteria, the British vote hysteria, it feels to me the market has been reacting positively to positive news. But what's the catalyst to get us higher from here, if possible?
Well, there won't be a whole lot. We've already had the recovery, so if you're looking, there's no better news because of this, so it's not going to do much better. I will say the only real catalyst is that this situation caused interest rates to plunge, and it will probably cause many central banks to be more dovish, basically lower rates more. And stock investors like that. They like inflation. They don't like, it's bond investors that don't like inflation. So the stock market is more valuable with lower rates. So we have lower rates right now than we did before.
Although the bond market hasn't done too bad in the last 30, 40 years.
Right, because they're worried about some sort of economic crisis from all this.
Well, here's the thing with the central bank argument for me. After the British exit vote, we knew the central banks had already set up emergency programs, so we knew that central bank policy would be more accommodation, and yet we had a two-day plunge that set a record for the biggest loss in terms of market capitalization, although the markets knew about this. In the meantime, we've had better ISM service data, better ISM manufacturing data. We had a jobs number that crushed all the estimates, things that normally would mean the Fed's going to raise rates, and yet the markets rallied in the face of that.
That's this twist. The economy's better than our rates, so to say. Like, we really shouldn't be at 1.4.
So we're having a cake and eating it, too.
Right. So the market gets the benefit of having low rates supporting everything and making all assets more valuable from real estate to stocks, and yet really, we're not in a recession, and things aren't looking that bad. I will say there's also this current, I think this is bad for the UK. I don't think it's bad for stock investors globally out of the UK, even in Europe, because I think ultimately this is a currency thing more than anything. That's why their currency is so weak, and that makes deals happen for, like right now, Airbus is doing really well compared to Boeing because the euro is weak and will stay weak now because of this situation, probably for a year or two as this unwinds.
What about, though, you mentioned currency, and some are saying, hey, the pound going down actually helps the UK, particularly as they branch out and start to focus on trade, not just Eurocentric trade, but trade with Asia, trade with America. It gives them a better chance to actually improve on that. Is that a net positive for them?
No. If they were Germany and they were a big exporter of not services but actually like cars and airplanes, then yeah, but no, because what it benefits is Euro countries, Germany, France. Again, they're now selling products to a world with a cheap euro that's going to be kept sort of artificially cheap by all this. The UK wants to be a financial service center. There's issues where they need to have the currency valuable. You kind of don't want to be, you don't benefit from a weak currency if you're trying to be the financial capital of the world. Right. So I see London not benefiting from this. I see Europe, even countries that are on the border, that are borderline like Italy, can theoretically benefit from the ongoing weak euro.
Well, I think they've benefited already, but the hint that they'll leave because I'm hearing bailout for Italian banks. And I don't know that would have happened if the UK had voted to stay in the EU. They would have certainly played harder ball.
It's definitely risky. Look, when you're buying these stocks in Europe now because they're down or they were down a few years ago, it is like things might get worse, and then other countries could leave. Then all of a sudden, who's going to support the loser countries in the EU? So there's definitely risk to invest.
Even though they'll have their own central banks and printing press, who will actually want those currencies? Thanks a lot.